This is Matt Calkins, CEO of Appian, and you're watching Taking Stock.
Time to rock and roll. 2 minutes to go until the closing auction down here on Wall Street for another set of all-time highs for the tech-heavy NASDAQ and the S&P 500. It's going to be a photo finish whether or not the broader benchmark index finishes above 7,500 for what would be the first time ever. Einstein of Wall Street, the great Peter Tuchman, joins me now for his take on today's tape. What did you see in terms of today's broader price action?
We saw a lot of buying action. I mean, there was, yesterday we mentioned, it felt like it was a melt up with lack of sell side. Today it was just nothing but buy side. There were sellers there, but the buyers were with determination and intent. And so we had over $1 billion to buy all afternoon, and the market just beautifully edged its way up with little bits of pullback, which shows like foundation. That's called a trend. Right, when you have a trend trade, those are the most profitable trades, right? Because you're really building a foundation as you go higher. If you go up, you'll pull back. It's not the same kind of a thing.
And I wonder, are you seeing conviction on the tape? Because it's not just tech doing the heavy lifting, it's energy, it's financials, industrials, utilities, telecom. Most of these sectors are moving the right direction.
It really feels like people are comfortable buying stocks again. Right now, there's always a different tranche of who's buying it today, who took it up to that level. It just feels like retail, institutional, everybody's coming in to buy.
And in the words of a wise man, buy stocks, not stuff.
There you go, buy stocks, not stuff.
The one and only, the great Peter Tuchman, the Einstein of Wall Street, thank you for being here. The one and only FDNY, set to do the honors. More Taking Stock after this. Boom, that's how it's done. A very warm welcome to the one and only FDNY, among the city's bravest. Thank you for your incredible service, and thank you for being here to bring about a close to the auction here on Wall Street today. Let's check your final tail of the tape for yet again another history-setting day. This is becoming like a regular thing. The S&P 500 up 0.7%. The Dow 30 also up about 0.7. The New York Stock Exchange Composite Index will finish up about 0.5%, and the small caps up 0.6. For her take on today's tape and much more, let's welcome in our longtime friend, Dina Jalbert, CEO of Align Advisory Services. Very grateful for your time here today.
My pleasure.
First time you and I are talking, though, after a much hotter than expected CPI and PPI inflation print earlier this week. Does that change the trajectory of the interest rate cut story this year?
I think so. I mean, I think those numbers were disappointing to a lot of folks, and so by virtue of that, there's going to have to be some sort of correction, and I think with the new Fed chair incoming, it's probably on its way. So we'll see when, but I think it's going to open up a lot of money, and there's going to be a lot of activity.
Dina, we know that CEOs inherently, they could be a bit more bearish than a lot of other analysts on Wall Street, people like Jamie Dimon in particular. Do you get the sense that CEOs are increasingly a bit more concerned about where the economy is right now?
I think your larger cap CEOs are, because credit is still expensive and there's a lot of global uncertainty and macro volatility. And so volatility breeds apprehension, and those CEOs, I think, are going to step back and not invest as much. And we're going to see returns down. But I think where you're going to actually see that money shift to is your middle market, and that's actually going to grow because they're going to feed the acquisition upswing that those larger businesses are going to have in order to grow, because it's easier to buy it than build it.
What have you seen with regards to M&A activity, and are we set for an even furtherance of a rebound for M&A activity for the back half of 2026?
Yeah, definitely. I think there's a lot of pent-up demand by buyers, both corporate and private and financial buyers. I think there's a tremendous amount of backlog, but I think also we're going to see a lot of sellers more willing in the second half of this year than they have been in the last even 6 to 12 months. Again, I think they were sitting on the sidelines worried about all this volatility. I think they've seen what it is or isn't going to do to their balance sheets, and now they're ready to plow ahead. They can't continue to sit and wait much longer. So I think you're going to see the gap and the bridge between seller expectation and buyer appetite start to converge.
I want to get your take on software stocks. You and I are taking a look here. Pretty strong, all things considered. Cloudflare, CrowdStrike, Datadog and Snowflake are down for the day, but more broadly, what do you make of the SaaSpocalypse conversation? Is it real, or just maybe a little bit of a reset for these software stocks?
I think it's going to be more of a reset. I think it is the age-old nice-to-haves versus need-to-haves, and so I think the softwares that really bring efficiency and operational scale are the ones that are going to come through okay. I think the ones that are the nice-to-haves that don't deliver that scale operationally are going to be the ones that are going to struggle a little bit.
We're also talking about some potential mega IPOs. There was a big one today elsewhere here on Wall Street. What are you eyeing in terms of a name like SpaceX? What does that mean for the state of the private market?
Yeah, I mean, the private markets have been thirsting to have a place to put AI infrastructure investment, and they got one today, right? So I think it just shows the thirst and the desire for institutional investors and retail investors alike to invest in that sector. And I think you're also going to see the downstream effect of that. Cybersecurity, IT, AI, government, aerospace and defense, it's all interrelated within these organizations. It's not just space or just AI or just tech. I think you're going to see this whole ecosystem have a similar round of investment like we saw today.
Yeah, maybe a bit of a restarting for risk appetite for retail and institutional investors alike. I could chat with you all show. Unfortunately, that's all the time I have. Please come back and see us again soon.
Will do. Thanks for having me. Thank
you. Ina Jopper of Align Advisory Services. All right, here are the top analyst calls that moved the tape earlier this morning that you may have missed. Thank you for that. First up, UBS reiterating NVIDIA as a buy, lifting the price target to 275. NVIDIA, the second strongest name in the Mag 7 so far year to date, trailing only Alphabet. They, of course, report results next Wednesday, May 20th. Next up, Goldman Sachs downgrading Whirlpool to neutral from buy, saying they see too many negative catalysts on the stock. Whirlpool shares, down 40% for the year. Finally, New Street analysts initiating coverage on Rocket Lab as a buy. They say the opportunity here still largely underpriced. Rocket Lab up now 5 days in a row here on Wall Street. Speaking of being up here on Wall Street, what a story for Ford here this week. New York Stock Exchange notable here, up more than 6.5%, headed for its best week in the last 6 years. It was up 13% alone yesterday, and it continues to rally. Analysts say Ford could generate billions in extra revenue through the energy storage market. Maybe not the first thing you think of when it comes to Ford, but it's a part of the new conversation. Shares up 10% on the year, now trading back at its 3-year high. Earlier this morning on the J.D. Durkin Show, I caught up with the great Ryan Dietrich of the Carson Group. I asked him why investor sentiment still feels so negative despite stocks trading at all-time highs. Here's what he had to say.
That's a great question. We've been seeing this for years. I mean, it is the continued doubt and worry, and we get it. It's the headlines. I mean, there's war, oil at $100, inflation, all this stuff that it matters. It matters to investors, but how people feel versus what they do. I mean, just a little bit ago, we got retail sales numbers. Came in right about as expected. Yes, we're spending more at gas stations. We understand that. But people are also spending at sporting goods shops. They're spending at retail. They're online. Those things are still strong. So you see one thing, and then, Michigan consumer confidence, lowest we've ever seen. It's kind of this dichotomy. The reality is we keep seeing it. And I just saw The Economist, who's usually a little skeptical. Let's leave it there. The recent cover shows like a person falling into the abyss, talking about the jobs apocalypse, and we can get into more of this if you want, but we're looking at the jobs market like it's improving. So we're being told one thing, people are doing another. I still think it's bullish from that contrarian point of view.
JC Peretz is a good friend of yours. He's a good friend of us on the show, too. Dude, you know how he is with magazines. Oh, yeah. He's the person I saw tweet this out. Are you as into the magazine covers, kind of going the opposite way as JC? It is a big one out today.
Yeah, I am. I started in this industry. I guess I got the bug in '99. But I've been in the industry, working in the industry for over 20 years. I started in options. And one thing I learned about options is if everybody's thinking alike, somebody isn't thinking. General Patton. Now, I'm not just being a contrarian to be a contrarian. I'll be very clear. But when we see certain things like underlying breadth is strong, credit markets are hanging in there, yet everybody's freaking out. And then you see magazine covers like that and some of the other, what was the other one? New Yorker just last week had George Washington, all sad, kind of beat up, red, white, and kind of blue. I mean, we don't invest purely on magazine covers. I'll be very clear. But when I see that, JD, I think that's a good sign. And yeah, we pay attention to that stuff.
So here we are. We just pulled it up. Shout out to the producers. That was lightning fast. The jobs apocalypse. Hope for the best, plan for the worst. And there's a very funny historical correlation between, by the time it gets to this point, it oftentimes does not play out. And by the time something is universally accepted or consensus, it's usually too late. What do you think is the most important thing investors are misreading about this economy more broadly right now, Ryan?
A great question. I'm going to kind of build on the theme we just had. One of the, I mean, yes, Carson Group, we can talk about earnings being strong. Every guest has done that and different things. We do think the labor market is really turned a corner here. I work with a really smart guy named Sono Varghese. He's our chief macro strategist. He dives all into this stuff. You know, he's been saying for a couple months now, labor market's improving under the surface. No one's really giving it credit. Now we've had 2 positive numbers in a row, and I get it. It's not like we're seeing 300,000 to 400,000 jobs a month like we were a couple years ago. But our economy, we probably only need, between 10 to 25,000 jobs a month, JD, and now we're starting to see that. ADP report's been solid a couple times in a row, being led by small businesses. I know initial jobless claims are still at 210,000, I think, this morning. And one more quick one, the JOLTS data. Quits actually had a pretty big jump last month. It's hard for us to think people are just quitting their job if they don't have a better opportunity. So I'm not saying the labor market's perfect, but I am saying the labor market could be this one thing no one's really talking about the second half of this year that could really help, because we know, I mean, the recent GDP number, a week ago, 2%. Well, like half of that was AI. We get it. AI spending, AI rollouts. Last 5 quarters, AI has been 45% of all the GDP growth. So we understand that. But we need the consumer to come back. Consumer is not great, but if the labor market improves like we think it can, that could be a big driver second half of this year that I don't think a lot of people are talking about. Then you see that cover. Clearly, no one's really thinking about it.
Ryan, you brought us a few charts. We're very pro charts here on the JD Durkin Show. We're very grateful. Let's dig into a few of these. Sell in May. Everyone knows that old school trade. Why has the market kept climbing anyway, despite a lot of these old adages, Ryan?
Yeah, first off, I sent you probably like 10 charts. Anybody ever sent that many? I like to know if I'm in the record books. I do love charts. You're right. We love telling stories through pictures and charts. Yes, selling may go away. These next 6 months are quote unquote the worst 6 months, but they've also been higher 9 of the last 10 years. And so blindly, we don't think we're going to have a sell and may go away. We've been bullish in the Carson Group. We think this is a bull market, a secular bull market. We get more into that. But one that I thought was really fascinating, we got 5% for the year at the end of April going into May, like we were this time. The rest of the year has been higher 23 out of 25 times. I mean, it's kind of, I call this like it is what it is. When you hear things like that with laying on with different things that we think are still positive, the momentum's a beautiful thing. And one of the things a week ago right now, the New York Stock Exchange advanced decline line hit an all-time high. So usually market breadth leads price. If you want to pick out one potential problem, though, since then breadth has been weakening a little bit. Listen, we've had a huge rally. Maybe we're due for a little bit of a pause, but overall, I don't think you should sell in May and go away this year.
Welcome back to this Thursday edition of Taking Stock, live from the trading floor of the New York Stock Exchange. Alejandro Vasquez joins us now. He is the co-founder and president of Nuvem Shop. You power online storefronts for merchants specifically across Latin America. Really grateful for your time today. Thanks for being here.
Thank you, JD. Pleasure to be here.
Talk to me about the opportunities, but maybe also the big challenges of doing work specifically in Brazil and operating and excelling in the e-commerce marketplace.
Yeah, well, Brazil, it's a really huge market, but it's a very demanding and very competitive market. When you look at Brazil, more than 200 million people, and when you look at e-commerce in particular, or retail in general, the brands that really win in the market are the ones that create unique experiences. And experiences is not only about the product, right? It's about the experience for the merchant. It's more than just price. And that's what we are looking and what we are working on at Nuvem Shop. When you look at the scenario, the competitive scenario in Brazil, it's very complex. I mean, it's a continental country, so in terms of logistics, it's very complex for the merchant to deliver to the whole country. Payments, it's also very complex. You have different kinds of payments, not just credit cards. The tax regulation is also very complex in different states. So when you look at the whole package, what merchants ask for, they ask for a way to sell direct to the consumer, but in a really easy manner. They want to have the look and feel of the storefront. They want to have their DNA of the brand represented on it. They want a frictionless experience for the consumers, and they also want to deliver faster, cheaper, and also provide good payment conditions for the consumers. So when you look at that, that's what they ask for. They want us to help them build that kind of business, D2C business in the online world, which is really complex again in Brazil. And that's what we are doing right now, helping more than 200,000 merchants, most of them in Brazil, from well-established brands like Maismu, like King Sneakers and Shorts Co., and also international brands who decides to work with us in Latin America because we solve all that complexity e-commerce requires.
Alejandro, I do a lot of these interviews every day, every week. I'm always asking about the ways that people like yourself are leveraging artificial intelligence. Are there ways that AI are being used in the e-commerce space in Latin America that might come as a surprise to someone looking in from the outside?
100%. Actually, what we've been working on is like the phase one of AI. It's something that was already existed before AI, which is conversational commerce. A number most people don't know. When you look at Brazil, 70% of the online transactions has an interaction through WhatsApp or Instagram or any messaging channel during the journey of the purchase, 70%. So what we are trying to do, what we are doing actually, it's improving dramatically that experience. It's not changing the behavior of the consumers, it's improving that experience. And our answer to that was Nuvem Chat, which is an agent, AI agent, which allows every merchant to interact with their consumers through WhatsApp and negotiate and recommend products and track the order and also make the purchase through WhatsApp with our payment solution behind it. So this is something that is very unique from Brazil and also for Latin America because WhatsApp has more than 95% penetration in the internet population. So that's the phase one, I will say.
Sure.
The phase two, it's about all the LLMs, which is becoming, it's still very small, but it's growing faster, which is becoming like the new product discovery layer we have, okay? And that's the consumer side. When you look at the merchant side, we are working to help our merchants become more productive because they need to improve their bottom line. So we launched more than 30 AI agents which help our merchants make better decisions and faster decisions with more insights, for instance.
It's a very exciting time, especially for investors here stateside looking for emerging markets. I have to leave it there. I'm out of time, unfortunately. Alejandro, please come back and see us again. It's nice to see you.
Thank you, JD.
Coming up here on the show in just a bit, the latest on the Clarity Act as it works its way through the hallways of Capitol Hill, plus a new announcement from FinTech TV we'll bring you shortly. You do not want to miss. A lot more Taking Stock coming up after this.
Woo! Yeah! Woo!
Earlier this week, FinTech TV lead anchor Remy Blair sat down with Dr. Paul Lichty of Forge Nano to discuss domestic AI chip manufacturing and a lot more. Take a look.
The U.S. is in a race against time to secure its domestic supply chain for advanced semiconductors as well as batteries, with a 2028 legislative mandate barring the Pentagon from using foreign-made battery cells and AI chip demand exploding. The pressure is on U.S. manufacturers to scale up fast. Now, Forge Nano specializes in precision nanocoating at the atomic level and is merging with Archimedes tech-SPAC partners to go public. The deal values the Colorado-based company at $1.6 billion. And joining us live here at the New York Stock Exchange to discuss the future of U.S. manufacturing is Forge Nano co-founder and CEO, Dr. Paul Liechty. Great to have you here. Thank you so much for joining us.
Thanks for having me.
Well, I know this is a national security issue, so tell us how your technology makes a difference when it comes to some of these U.S. industries.
Well, if we're going to re-import manufacturing in the U.S., we have to do it by leaning forward on new technologies that are homegrown. At Forge Nano, we've developed and scaled an atom-by-atom manufacturing process, which allows us to unlock significant performance improvement and manufacture very small features like what's nascent with semiconductors. And so being a company that has leaned in on that advanced manufacturing, it allows us to make better products, whether it's batteries, whether it's semiconductors, unlocking advanced packaging. You need that level of atom-by-atom precision to be competitive and to move the technology forward.
And Paul, when we talk about bringing manufacturing back to the U.S., it's not like flipping a switch, as it actually takes many years to actually accomplish this. And I understand that you plan to expand into data centers as well as quantum computing. So tell us your vision for this and also timeline.
Yeah, our technology is a platform that allows us to unlock better manufacturing capabilities across different industries. But as you said, building back manufacturing in the U.S., it takes the entire supply chain that has to get built up and grown at the same time. We've seen a big need now, especially on the defense side of the market, to integrate new high-performance products and require that they're made in the U.S. with an advanced supply chain. So with that, we're able to bring all of this together at the same time to start building back a manufacturing base in the U.S.
And for the layperson out there who's trying to understand both the manufacturing side as well as the technology side, can you simplify this for us?
Yeah, it's, what we do is like Legos, and having the ability to use single atoms and stack them like Lego bricks, it gives you a level of control that's just as good as humans are capable of. So anytime that you want to customize or make an improvement on a product, getting down to that level of detail just unlocks massive capabilities.
And in terms of industries, I know that you've highlighted some that this will affect. What is your expectation as we move forward, not just into 2026, but also beyond, and especially given your listing?
Yeah, I mean, we're excited to be going public. It gives us a broader platform to kind of convey to the public what it is we do, how important and impactful it is, and how key leaning in on newer innovations, advanced manufacturing technologies is if we're going to re-onshore manufacturing in the U.S. and build out that entire supply chain.
Yeah, and building on what you just said, there is a 2028 mandate barring the Pentagon from using foreign battery cells. So as we consider these things, what does it mean for national security and also defense requirements, since it's not simple?
Yeah, there's a high bar, a high level of supply chain redundancy, resiliency, a lot of hoops to jump through to supply and be a trusted supplier to the Department of War. But it's something that needs to happen, and we've gotten ourselves into a bit of a situation where there was too much exporting, so the actual manufacturing base to supply not high performance but secure supply chain products has to be rebuilt, starting now. So we've been working in Congress with Department of War for many, many years to help identify those key supply chain blocks and help either deploy capital or write policy that helps to build that up in a way that's both economically viable and provides security to the warfighter.
Well, Paul, it was great to have you here. Thank you so much for joining us, and thank you so much for sharing the story of your organization.
Thanks for having me.
Thank you.
Welcome back. I'm Scarlett Sieber with Money 2020, and this is how fintech companies actually make money. The series where we stop asking whether something sounds innovative and start asking the more important question: does this actually work as a business? Today we're going to be talking about Sixfold AI, and this one matters because underwriting is where financial services quietly make money or quietly lose it. Sixfold builds AI-driven underwriting and decision systems for insurers and lenders. Not chatbots, not dashboards, real infrastructure that determines who gets approved, how risk is priced, and how capital gets allocated at scale. So how does this company Sixfold actually make that money? First, this is enterprise SaaS, people. Insurance carriers and financial institutions pay recurring multi-year contracts to use Sixfold's models across underwriting, pricing, and portfolio management. These are not experiential ratios and pilots. Underwriting is mission critical, and budgets reflect that. Second, usage-linked economics. As insurers process more applications, submissions, or policies through Sixfold, the value and the revenue scales with that volume. The platform gets more useful as it handles more real decisions. Third, deep workflow integration. Sixfold doesn't sit on the side. It plugs directly into the underwriting workbenches, the policy systems, and existing processes. Once it's embedded, switching becomes difficult, and the institutions don't rip out systems that touch core risk decisions lightly at all. So here's the thing that a lot of people underestimate. Underwriting mistakes don't show up immediately. They show up months or years later, when loss ratios spike, reserves tighten, and suddenly the math just doesn't work anymore. That's why better underwriting commands real money, because accuracy compounds. Why now? Because underwriting is under a lot of pressure from every direction that you look at it. The loss ratios, those are rising, capital is more expensive, and regulators are paying closer attention. The good old, good enough underwriting models that worked back in the days, they're not working anymore. That's exactly why Sixfold's in the spotlight right now. Straight off the $30 million Series B raise in late January, investors backed the idea that AI isn't just an efficiency layer anymore, it's becoming core financial infrastructure. And this is where a lot of the other AI conversations miss the point. Sixfold isn't about prettier reports. It's not about shaving a few minutes off of a workflow. It is about improving the economic decision itself. Who takes the risk, at what price, and whether margin survives over time. When underwriting gets it right, everything downstream looks healthier. When it gets it wrong, well, no amount of growth or marketing can save you. Sixfold doesn't monetize hype cycles. It monetizes better outcomes, quietly, repeatedly, and at scale. And that, my friends, is how Sixfold AI actually makes money, by sitting exactly at the moment where financial services either make margin or make mistakes. That's not flashy, but it's exactly where the real money lives. Have a fintech you want us to highlight? Drop it in the comments, and it might just make the cut. In the meantime, back over to you.
Welcome back to the show. Beginning June 1st, FinTech TV is launching a new daily live show. It is called Capital Markets, America's Tamina. It's set to connect Wall Street with the broader Gulf region through simultaneous broadcasts, both from Dubai as well as from the iconic trading floor of the New York Stock Exchange. My warm congratulations to the entire team at FinTech TV on that exciting announcement. Speaking of exciting, all-time highs for the market today, and that's going to do it for today's edition of Taking Stock. Thank you for watching. We'll see you again tomorrow from the big board.